Hi, my name is Liz and I'm here with Jason today. Welcome to our second segment of Facebook Live, and our topic today is interest rates and their role in your credit life. You can use the hashtag BoostCredit on Twitter, and you can comment down below any questions that you have throughout our segment. And let Jason introduce himself.
Right on. Thanks, Liz. Well, like Liz said, my name is Jason Williams, and I'm a customer support representative here at RentReporters. I primarily focus on reporting your on-time rental payments by verifying your rent with your landlords. Now, if you're just joining us and you don't know much about RentReporters, let me tell you a little bit about us. Now, up till now, your rent payments have had no impact on your credit score. Well, RentReporters decided it was time to change all of that. We report your on-time rental payments to the credit bureau, which will increase your score. Now, we are definitely committed to helping you get the credit score that you deserve, and we work very hard to help you do so.
So we're going to quickly talk about our goals for today, and that is to better understand interest rates and their role in your credit life. And the first one that we're going to cover is how your credit score determines your individual interest rates and how that's ultimately going to affect any savings that you may have. And then in the second segment, we're going to go over how the overall state of the economy can affect credit and its availability. So quickly, we're going to go over what is interest rate. Interest rate is the rate that you are charged for borrowing money, and that can include any cash, consumer goods, or any large assets that you would like a car or even a home. So we're going to flash all the way back to 7th grade algebra, and we're going to talk about the equation of interest, and that is your interest is actually equal to the principal, which means the amount that the item costs, times your rate, usually your APR, and the time that it takes you to pay off that loan. So the important aspect of this equation is that everything is multiplied together. So if the principal is large or the rate is large, or you take a long time to pay off that loan, that means that your overall interest is going to be a lot higher. So we want to make sure that we can help increase your score in order for you to help get a loan and have it at a low interest rate.
Now, society is becoming increasingly dependent on using credit to make purchase decisions. These days, good credit is used for more than just getting a credit card or a loan. Specifically, more and more businesses are making the case that you must have a good credit score before they extend any products or services to you. Since your credit is defined by how much you've paid or not paid your bills in the past, many businesses, landlords, mortgage lenders, utility providers, and even employers use your credit to predict your future financial responsibility. Anytime you need to borrow money or even retain services, your credit is called into question. This is why maintaining a good credit score is so important.
So having good credit can make a huge difference in pulling out a loan and getting a low interest rate. And as a result, a low interest rate can mean thousands of dollars of savings.
To demonstrate how credit affects the interest rates when financing a car, I'd like to give you an example. First, I'd like to introduce you to Carl and Judith. Carl recently got a new job and needs a car to get to work. Now, unfortunately, he's had some financial difficulty in the past, and as a result has a low credit score of 430. He does qualify for a car loan of $30,000 with a 3-year term and is given the rate of 12.4. Judith, on the other hand, also got a new job and needs a car to get to work. She reports her rent, pays her bills on time, and has a credit score of 780. She does qualify for a car loan of $30,000 with a 3-year term as well, but due to having such a good credit score, she's given the rate of 1.6%. Now, using that middle school formula that Liz presented earlier for interest, we'll see that Carl's total interest will be $11,160. Alternatively, Judith's total interest will be $1,440. So you'll see that's quite a difference. And due to Judith having great credit, she received an interest rate of 10.8% lower than Carl's and is able to save $9,720 for the same car.
So now we're going to look at Carl and Judith again. So already Judith has beat him out by saving thousands of dollars on a car. And now they're both applying to buy the same house. and that house costs $400,000. But due to their differences in their credit score, they pull out a loan. They actually both get approved for a loan of $30,000. Carl, his interest rate for this loan is 4.6%, while Judith's rate is 3.1%. This means that Carl pays approximately $2,700,000 in interest, bringing his grand total to about $600,000, whereas Judith pays only about $20,000 for interest, and she ends up paying about $500,000 for the total house. So by having a better credit score, Judith avoids paying $100,000 for the same house, just based off their credit score and for the same loan pulled out. So now, how can Rent Reporters make a difference? We just seen that Rent Reporters is designed to help you improve your credit by reporting your on-time rental payments, and we've learned from our previous two examples how having a better credit score can reduce interest rates on loans and as a result save you thousands of dollars in the long run. And a better credit score can help reduce your interest rates on nearly every credit product across the board, like student loans, credit cards, mortgages, and even more. So working to improve your score with Rent Reporters can not only help change your score, but it can also change your life and your future and save you lots of money.
Now let's take a look at the impact of the economy on everything. So though your credit score will have a huge impact on how low of an interest rate you can receive, there are other factors that are in control and that guide these interest rates that we have no control over. These factors have to do with the state of the economy at any given time, which is also called the business cycle. Now, the business cycle has 4 phases: expansion, inflation, contraction, and recession. Think of it as a wave that continues to go up and down. Now, this wave continues and does not stop and repeats itself. As rise in consumer demand causes the expansionary period. And now, when we have a growing economy, we're in the expansionary period, and this means the economy is growing rapidly. Employment is high as well, and consumption is also high. As a result, the Federal Reserve will take typical raise interest to keep stable prices and prevent inflation. The economic result is that the raise in interest rates means banks are willing to pay more for interest in their deposit accounts, but this also means that the cost of borrowing, or the interest rates, will also raise. In effect, the price of loans is greater, so only the people that will need to get these loans can get them and afford them, and there are less loans to give out.
So now, in contrast to that, we're going to talk about contractionary periods. So this is when the economy plunges and we end up going into a state of contraction. So this is when unemployment rates tick up and the stock market tends to decline. So as a result, they're going to typically lower interest rates and attempt to stimulate the economy. Now, what this means is that there's going to be a decrease in interest rates because, again, they're trying to stimulate the economy, trying to bring more money into it. So what this ultimately means is that interest rates are going to be lower. And in effect, if it's lower, it's going to make it more affordable for you to purchase a car or a home or take out any general loan. So I guess you can say it's more ideal to pull out a loan in a contractionary period.
All right, now we just want to give you a quick breakdown of what we just discussed, these two concepts, expansionary and contractionary. So in an expansionary period, the feds raise interest rates to combat inflation. Lenders are more cautious about loaning money, so they raise interest rates.
And in a contractionary period, the feds lower interest rates in hope to induce spending and borrowing, which would in turn stimulate the economy. So as the economy continues to fluctuate or go through this wave cycle of expansionary and contractionary period, the Fed's goal is to keep maximum employment and stable prices constant. So as an individual consumer, there's actually little that you can do to affect the state of the economy or the Fed's action. So what we can do is control our credit score.
There are definitely a few things we'd like you to take away from our presentation today. First is the importance of credit. A good credit score can directly impact the percentage of your interest rate. Not being in control of your credit score can contribute to higher than normal interest rates, which leads to an increase in consumption spending. Basically, you're spending more money. It also has an effect on the economy. When the Federal Reserve changes the rates, it directly affects nearly all other rates of loans. When they raise rates to induce a contraction, less loans are made. When they lower rates to induce an expansion, more loans are available.
So that's where we can come in and help impact your life. Rent Reporters can have a positive impact on your credit score, which not only puts you in a better standing for an ideal interest rate, but it also puts you in the driver's seat to control the availability to pull out a loan, regardless of the state of the economy. So right now we're going to open it up if there are any questions for you guys, and we're going to just take a look. So we actually have Cynthia in our audience again, who is going to feed back any questions that you guys may have and that we can answer for you. Cynthia, do we have anything?
Hi everyone, ask away. Not just yet.
Well, don't be shy. If anything comes to mind, just reach out to us.
So we're going to wait about a minute, and at any time you can use the hashtag BoostCredit on Twitter, or you can even comment down below, and we'll be able to answer your question. Even if we can't do it within this live segment, we can do it later on. You can even call us. Our number is available on our website and on our Facebook page, so go ahead and reach out to us there. You can reach us via HipChat. Not HipChat. You can reach us via
Our online chat.
our live chat. You can talk to us via live chat, or you can send us an email, and we'll be able to answer any questions that you have. Any questions?
Not yet. Oh, we have one. Are credit cards a good start to build credit if I only have loans to pay back?
Certainly. I'll take this one, Liz. Credit cards are definitely a good idea to get when you want to improve your credit. If you do have lower credit score, there are definitely credit cards that can help build credit. And even if you don't have credit at all, there are specific credit cards you can get that can help build that credit as well. Now, just be careful with the amount of credit cards that you do choose to open up. If you are trying to build your credit, it's good to really start with one. And maybe try to make sure it's associated with one of the major banks and not associated to a department store or one of those credit cards.
All right, we have another question. How do I sign up for this service?
You can actually go to our website, www.rentreporters.com, and you can use the easy sign-up process, or you can even call into one of our live agents and we can sign up for you.
It's a really simple process that will lead you step by step.
It'll take you no more than about 5 minutes to complete. And if you have any questions if you want more questions answered about what we can do for you, again, we're here to answer any of those questions in this time frame.
They don't specifically need to do with be specific to our topic.
While we're waiting for questions to come in, I want to quickly segue into our topic for next week. We're going to talk about factors that positively and negatively affect your credit score. So look forward to that. That'll be next Friday, where you can tune in. And I think we have a question.
Not yet.
Okay.
Oh, I just wanted to say next week, same time, 11 a.m. Pacific Standard Time.
That's right. Just to reiterate, in case you did not hear, our helper, Cynthia, we'll be meeting next Friday for our next presentation at 11 a.m. Pacific Standard Time.
Okay, so we're going to actually close up this segment, and again, don't feel afraid to ask questions, even if we're not in the live segment while you're watching this video. Feel free to comment down below or call us in, and we'll be able to answer any questions that you have.
Definitely. We want to thank you for joining us today. It was a great time. Hopefully you got something out of it, and we'll see you next time.
Thank you.
Bye.